I am AI Avatar of CA Ratan Mundra. Are the new labor codes and revised income tax rules going to reduce your take home salary? This is one of the most important questions for every salaried employee today. The answer is not straightforward. While your monthly salary in hand may decrease, your long term benefits like Provident Fund and gratuity could increase. At the same time, your final tax liability may depend on whether you choose the old or the new tax regime. So instead of looking at just your CTC, you need to understand the complete picture. There are two major developments impacting your salary. First, the new labor codes, which redefine how wages are calculated and how salary structures are designed. Second, the revised income tax framework, where choosing between the old and new regime becomes crucial. Together, these changes will directly affect your take home salary, tax outgo, and retirement savings. Most companies are currently in a wait and watch mode. They have conducted internal simulations and impact analysis, but full implementation of salary restructuring has not yet taken place. This is mainly because final rules, timelines, and state level notifications are still evolving. So while changes are expected, they are not fully rolled out yet. Traditionally, companies designed salary structures in a way that basic pay was kept relatively low, usually around 30 to 40% of total compensation. The remaining amount was distributed through allowances like HRA, special allowance, and reimbursements. This helped reduce statutory contributions such as Provident Fund and gratuity, thereby increasing take-home salary. Under the new labor codes, the definition of wages becomes broader. In practical terms, wages are expected to be at least 50% of total remuneration. This reduces the flexibility to allocate salary into allowances. As a result, a larger portion of salary becomes fixed pay, increasing statutory contributions and compliance requirements. When the basic salary increases, Provident Fund contributions also increase, since PF is calculated as a percentage of basic pay. Similarly, gratuity calculations are linked to wages. If your total CTC remains unchanged, a larger portion of your salary will go toward these long-term benefits. This directly reduces your monthly take-home salary. While your take-home salary may reduce in the short term, there is a long-term benefit. Higher contributions to Provident Fund mean better retirement savings. Similarly, higher wages improve gratuity benefits over time. So although your monthly liquidity may reduce, your financial security in the long run becomes stronger. In some cases, companies may cap PF contributions at the statutory wage ceiling of 15,000 rupees. This means your contribution will be limited to 1,800 rupees per month. This can help maintain your take-home salary. However, the trade-off is lower retirement savings. So this decision should be made carefully based on your financial priorities. Now let's look at taxation. The old tax regime allows various deductions and exemptions, such as HRA, education allowances, and other benefits. The new tax regime offers lower tax rates but removes most deductions. Depending on your salary structure and eligible exemptions, the old regime may still be more beneficial. So choosing the right regime is critical. The final impact on your salary depends on three key factors: your revised salary structure, your Provident Fund policy, and your tax regime choice. Before your next appraisal discussion, ask your employer for a detailed salary simulation. Compare your current and revised structure. Evaluate tax under both regimes, and only then negotiate your compensation. Because in today's scenario, understanding your salary is more important than just increasing it. Moonses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. A pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup. Operational support and handling complaints, risk management renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BAT, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.